how to structure your property business to be tax efficient as well as legal. Fantastic. So guys, unfortunately, taxes taxes have to be paid. And what I didn't know when I first started in property is how many property taxes are applicable to us. If you have a look here on the screen, this is a snippet from SARS's website, and you can see that there are numerous different types of taxes there, some that you might not be aware of. Obviously, not all of these are applicable to us, and later on this evening when Thierry takes over, he'll be sharing really the insider secrets to what taxes are applicable to us and how we can be efficient as possible with them going forward. Okay, so one more thing, please always go and check sars.gov.za. This is a recorded session and we're recording it in September or October 2020. If you're watching this at a later stage, please note that the taxes and the laws might have changed by then. So we're giving you the information today as best that we have right now. But obviously as time goes on and these tax tables are updated and information is changed, please make sure that you're always keeping up to date with that. So just go check out www.sars.gov.za. You will always find all the updated information there. So Thierry is a coaching student of mine. He's also become a good friend. And essentially Thierry started his property journey, as he mentioned, 2 years ago. And he kind of fell into it with a couple of friends and paid his school fees because he bought liabilities as opposed to assets. And the thing is, he just wasn't educated, I guess, or hadn't had the knowledge yet to really know how to turn this into a business. So I met Thierry about 2 months ago. He attended one of our webinars, and then he actually moved forward with our coaching program and became a student of mine. And we're now in the process of going through the steps to becoming a professional property investor. So because he's a new student and we're recently going through this program, I thought I'd share with you the journey he's taking and the 5 steps that you can take to become a professional investor. So these are the 5 steps to buying your first investment property. I did see on the polls that most of you are new to property. So guys, please, if you have a pen, paper, notepad, whatever it is, make some notes. The recording will be available later on, but this is a session where you get to really learn some secrets that you might not know. So there are 5 steps to buying your first investment property. Step number 1, I think this one goes without saying, but you got to find a good investment opportunity. Step number 2, you have to do your due diligence to ensure that it's a good opportunity. Number 3, secure the offer with an offer to purchase or an OTP. Find the money, also very important. Sorry, Thierry, can I just ask you to go on mute there? There seems to be a bit of feedback. Thanks, man. And then finally, set up the structure. So over tonight's webinar, I'll take you through the first 4 steps and give you some tips and techniques on how you can get started. And then when we start talking about the structure, that's where I'm going to bring Thierry on as a tax consultant. He's going to share with us what we can and can't do and how best to make an efficient decision with our taxes. So first of all, finding the deal. This is one of the most common questions that I get is where are all of these great deals? There's 2 things that you've got to look out for. Number 1, you have to look for motivation. Now, motivation is critical. If you're not finding a motivated seller, you're not able to get a discounted offer price. And the only time you really make money in property is when you buy at a discount. So it's about finding a motivated seller, number 1. Number 2, it's about finding equity. Now, what I mean by equity, if you go and buy a property, let's say in Midrand, and it's a new build, a new development, you're not going to make money in that kind of opportunity because 1, there's no motivation, and 2, there's no equity. But if you decided to go to an older area where houses are 20, 30 years old, there's a lot more equity in the deal. Let me explain. So let's say a property, let's say that somebody bought a property in Midrand 20 years ago. Okay, they bought it for R1 million. Now, over the 20 years that they've had this property, they've obviously paid off a substantial amount of the bond. So they might be left with, I don't know, 100,000 Rand outstanding. Now, when we as investors come in and we want to put a sneaky offer in, a cheeky offer, remember, you've got to buy low, and we come with an offer of, I don't know, 700,000, as long as the owner accepts it, the bank will accept it. right? Now, the reverse is also true. If you buy from an owner who's had the property for 2, 3 years, so they bought it at 1 million, they've held it for 2, maybe 3 years, they've probably only paid off about 100,000 Rand of their bond, which means that they still owe the bank 900,000. So we come in with a cheeky offer. We say 700,000 is our offer. Even if the owner accepts it, the bank will reject it because there's still 900,000 Rand outstanding. So that's one of the key things that you need to look for, guys, is a motivated seller. Plus, there needs to be equity in the deal. So my recommendation is to go to the older areas. Go to like Kempton Park in Johannesburg would be a great starting point. Or you want to go to your lower income, older areas is where you're going to find your deals. Now, what you see on the screen are just 4 ways in which I find my property deals. In the top left, you've got their estate agents or letting agents or people in the property game. So a lot of the deals that I find come from estate agents or builders or attorneys, people within the property space who then introduce me to a distressed seller. On the top right, you've got auctions. So it's not for everybody. Not everybody likes to go to an auction. And if you are considering an auction, please make sure that you do your due diligence. There's a concept in the auction space known as voetstoets, which means you buy the property as is. So if there's a delinquent tenant in the property, or if the property is doesn't have the right approved building plans, it doesn't really matter. If you make a bid at the auction house, you buy what you get. Bottom right is Property 24 or Private Property. Those websites don't always have very much motivated sellers, but it's a good platform for you to go and see what's in the market. Bottom left is a specialized distressed property website called Property Pick. So go check them out. Another option could be Mamela Estates, also an online estate agency that focuses on distressed leads. So that's the first thing. Using all of these different platforms, you can find a deal. Number 2, due diligence. Now, these are the steps that I would recommend you do, and these are the steps that me and Thierry are going through with his first investment. Number 1, run the numbers. Number 2, research. Number 3, get proof of income and expense. Number 4, go view the property. Number 5, question the tenants. Number 6, get a renovation quote, if applicable. So when you're running the numbers, obviously I hope that you use our app, which is the www.myapp.property.online. And you want to be looking at mostly these kind of metrics. You want to see your gross yield, which will tell you if an area might cash flow positively or not. Your return on investment, which is your buying decision. Remember, if you get let's say a 10% ROI on a property deal and you're getting a 10% interest rate at the bank, those two are on the same level, which basically means that you should rather leave your money in the bank because the bank is safer. But if you're getting a 10% interest in your bank account and your opportunity of a property is bringing you 20 or 30%, it makes more sense to take your money out of the bank and invest it into the property deal. And that's where you've got to balance your risk versus reward. Rate of return is when you're looking at a long-term property transaction, and then obviously you want to make sure that you've got an exit strategy. So you might be buying a property to hold and rent out, but how would it work as a flip? How would you be able to exit that deal if things went wrong? Because, as great as property is as an investment asset, it's not always risk-free. Number 2, sorry, Thierry, I'm just going to quickly go here because there's a bit of sound in the background. Oi, there we go. All right, try that again. There we go. Okay. So, number 1 of your due diligence, running the numbers. Number 2, doing area research. I recommend a tool called TPN. What you're seeing here on the right are just some snapshots of a TPN report. The report tells you what the rental price trends are, so you can see what an average price would be for a rental sectional title or freehold property. You can see the rental price index, so what are the chances of the prices escalating? So could the rent go up in value next year? You can also see what your payment profile is of your tenants. So are they low risk or high risk tenants? And then you can see some property transactions, the number of properties that have sold and what the average price was. So it just gives you some sense of what the risks are, the demographics, the affordability of your tenants, the average rent, and any applicable escalations. Proof of income and expense. This is critical, guys. When you're starting out the property journey, your estate agent's going to be your main source of information. So you're going to go and look on Property 24, you're going to look for a deal, and the estate agent's going to say, yeah, you can make 20,000 Rand rent, you can make 50, you can make 100,000 Rand rent. Now remember, the estate agent is motivated by commissions to try and get you to make a decision. So I'm not saying that they do this, but they might, tell you what they think you want to hear to help you make a decision. So yes, when you're first looking at a deal, you have to trust what the estate agent says. But over time, you want to be able to say, no, well, you need to be able to prove that I can make 100,000 Rand rent. You have to prove that this is what the rates and taxes are. You have to prove to me what the levies are. And guys, there is proof like that. If you look here on the bottom left, this is a rent roll. So this is a proof of income for a block of flats that Thierry and I went to go and look at. So you can see what the deposits are, what the rent total is, what the parking is. So we can see some sort of proof that yes, we can make 35,720 Rand in terms of income off this deal. And on the right hand side, you're seeing proof of an expense. This is a snippet of a COJ bill. So I can see very clearly what the rates and taxes are, the water expense, the electrical expense, the sewage expense. Right? Because running the numbers is important, but if you're running the wrong numbers, then you're not making an educated or informed decision. So running your numbers with qualified proof of income and proof of expense is critical. The fourth thing you want to do when you're doing your due diligence is go and view the property. Now this is one of the properties that Thierry and I went to go and view. It's 40 units, so it's a massive little development. There you can see Thierry with the estate agent, and we're just pretty much going through the property to see, what's happening. So this is really important, guys. I don't recommend you buy a property without viewing it. Maybe if you're an experienced investor and you've got a good builder who you trust to go and view the property, but otherwise, always go view the property. And I must just commend Thierry for flying through to Joburg last weekend with me from Cape Town. He's into the rental strategy, and unfortunately the rental strategy doesn't work in Cape Town, or at least I haven't found the right area for it. So he's interested in investing, and he's committed to making the flight to Joburg to go and really make this real. So I think that's really cool. So that's number 4, view the property. Number 5 of your due diligence process is you have to question the tenants. Okay. One of my favorite things to do is when I'm looking at a rental property or looking at buying an apartment is to ask the tenant some questions. Things like, how long have you stayed here? Okay, that gives you a sense of, whether they plan to stay for longer, or if they've been a good tenant. If they've just moved in, then I'm not sure if this is going to be a good tenant or a bad tenant, and I have to factor that risk into my calculation. If they've been there for 5, 6, 7 years, and I can see some past bank statements of them paying regularly on time, I know it's a good tenant and I can de-risk my numbers. Are you employed? Very important question. For how long and where? So if they're employed, where are they employed? Maybe phone the employer and just make sure that they're employed, make sure that they're earning the salary that can justify the rent that you might charge. Anything you want to change? One of the most important questions, because again, the estate agent might tell you that the house is just perfect, that there's no problems, but the tenant has no reason to lie to you. If there is some damp problems, the tenant's going to tell you, yeah, there's some damp issues. If the geyser isn't working for whatever reason, the tenant's going to tell you. If the doors are broken or there's something wrong with the property, trust me, the tenant is going to open their mouth and you get a better sense of what you're actually buying. Number 4, do you feel safe? Very important. I want to know that the tenant feels safe and comfortable. If they don't feel safe, then you might be buying in the wrong area, or again, factor that into your numbers and adjust for that risk. And then the final question I would ask is, would you recommend your friends to live here? And if the answer is no, again, you have to question, is this the right area? Is this the right kind of investment that I want to buy? If not, how can I de-risk myself? This is all about risk and reward. That's the business that we're in. Okay, sure. So that's already a lot. Number 1, find the deal. Number 2, run the numbers, do your due diligence, meet the tenants, etc. Number 3, once you've found a deal, you've done your due diligence, and you've gotten to a point where you said, yes, I actually think that the offer price of R1 million on this deal will make sense. You need to secure that offer with an offer to purchase, an OTP. which is essentially a legally binding document that binds you and the seller to a specific offer price, and you've got some suspensive or subject clauses that allow you to exit that contract in the event that you want to exit. I've got a couple of videos of this on my YouTube channel, so go check it out if you want to know more detail. That's the third step. The fourth step is find the money. Right, find the money. Now, my recommendation is, especially if you're starting out, is use the bank's money as much as possible. Now, the bank is quite strict. They require you to have a good salary. You have to have a certain affordability. You have to have a good credit score. So there are some limits in terms of bank finance. If you're unemployed, it's going to be hard to find the bank's money. But the bank, if you can access their money, is the cheapest money you're going to get. If you don't have the opportunity to go to a bank, I would recommend going to a bridging finance or a commercial finance company, something like a TUF, TUHF, or combined finance. Those are companies that loan to investors without the need for you to present your salary. The trick with them is that they don't necessarily provide you with 100% or 90% loan to value. They'll give you limited loan to value. They won't give you the full amount. Again, you got to factor that into your numbers. Another opportunity for you is to do some to work with investors. So to partner with someone who might have some capital, who might have a salary, who can then justify to the bank the right affordability to get a loan. Right. So partnerships are really important. You can go on it on your own, try and get a bank loan. You can go into a partnership where you loan money from someone or go together to the bank to loan a bigger amount. Another option could be to start with a sourcing business. Sourcing is something that a lot of people start with. That's where you find a good deal and you sell it to an investor for a fee. Obviously, over time, as you start doing more sourcing deals, you can build up some capital to a point where you've got enough for the down payment and enough money to essentially execute your first deal. But guys, finding the deal, finding the money, those are pretty much your key tasks as an investor. You've got to get comfortable asking people for money. Again, on my YouTube channel, plenty of different videos on how you can approach angel investors, how you can use bank finance, etc. Number 5. Once you've done step 1 to 4, you've gotten to a point where you've accessed some money, you've got a secured offer to purchase, the deal makes sense, you've viewed it, you've spoken to the tenant, you're feeling, and things are good. The next step is to decide on what structure you're going to follow. Are you going to buy in your personal name, in a company, in a trust, or in a partnership? Now, in order to determine the best structure for your investment, you've got to understand what the different structures, the different taxes applicable to all these different structures. And that, guys, is where the brains of the operation, Mr. Thierry Hector, is going to take over. He is a chartered accountant, a tax consultant for KPMG. He's a property investor, and his focus areas are buy-to-lets and multi-lets. And unfortunately, ladies on the call, he is taken. He is in a very happy and healthy relationship. So unfortunately, that's off the cards. But he is here tonight to share with us some exciting and interesting aspects of tax within the property space. So I'm going to stop sharing, and I'm going to unmute you, and then over to you, Thierry. You can share your screen and take us through all of that information.
Thanks, Laurens. Let me just share my screen before we start. Laurens, can you let me know if you can see that?
Sorry, man. I was on mute there. Can you hear me now?
Yeah, can you hear? Are you able to?
Yeah, I just want to quickly say that there seems to be quite a few disappointed ladies on the call right now, Megan and Asanda and Yassine. But yes, I can see your slides. And guys, while Thierry is going through his presentation, please post questions on the questions tab. We'll happily answer them at the end of the webinar. Over to you.
Thank you, Laurens, and thank you for that introduction. I'm sorry if I'm working on 2 screens, so if I'm looking this way, I'm not trying to ignore anyone. I need to look at my screens here. So good evening, everyone. I hope everyone's keeping warm. and safe. Before I start, I just want to say thank you to Laurens for giving me the opportunity to present to his audience. I know tax isn't the most exciting subject, but it's something that is necessary, and I see a lot of people getting it wrong. People always treat tax as something to correct rather than something to plan for. And the only time I see people making change is when SARS issues them with a query. So I'm very happy that you guys took this time out of your day to come and listen to this webinar, as you never know, you may learn something. And always, just as a disclaimer, I'm not a financial advisor or a property attorney. So the things that I'll be presenting to you is general in nature and doesn't necessarily apply to you. I would always advise that you speak to a consultant or a property attorney before you opening any structures, because these things need to be dealt on a case-by-case basis. Without further ado, we'll start with the agenda. So the first slide is your normal introductory, where I'll give you a background of who I am and why you should be listening to me. We'll then talk about what tax efficiency is and what the goals are that are generally people are looking for in their structures. We'll then look at different property vehicles and which people generally use and the applicable tax rates. And then we'll look at the different tax types which you may come across in your property journey. And then we'll look at an overview of gross income and general deductions. I see these questions come up in social media quite often, so I think it'll be quite good to touch on the subject. And then we'll go over some practical examples, showing you how different income yields affect different vehicles. And then I will show you the type of consultants which you can rely on. And then lastly, we'll end off with common misconceptions regarding tax. So a little bit about me. I'm born and bred in Cape Town. Spent the majority of my life here. I studied just like everyone else, thinking that it's the sure way to get far in life. I went to UCT, got my Bachelor of Business Science in Accounting, and then after my postgraduate diploma in Accounting. Then I did my articles at one of the big 4 auditing firms, where after I registered as a chartered accountant. I'm now working as a tax consultant in the same auditing firm while studying towards my master's in tax. So I don't see myself working for too long in tax. I purely did this to learn and expand my skill set. My passion has always been property, and so tax is just one of the skill sets that I can offer my team. So some of my experience in audit involves mostly looking at large companies in the financial sector, where I gained a large amount of knowledge and skills. Now that I'm in tax, I do quite of audit assist work, preparing annual returns, reviewing tax calculations, and then also working with high net worth individuals. So yeah, that's me. Let's move on to the next slide for tax efficiency. So tax efficiency, what is it? It's basically an attempt to minimize your tax liability when given different financial decisions. So basically, it's achieving the same outcome with paying the least amount of tax between financial decisions. So I need to caution everyone here. There are a set of standards in the Income Tax Act called General Anti-Avoidance Rules, and I don't think the majority are aware of something like this because it's not actually used in practice. So as the Act only promulgating this quite recently. And basically what this means is that the primary reason for any decision or structure cannot be to reduce tax. That being said, there are, as I said before, there are no court cases where SARS has made an argument based on this because of how wide it is. Basically, so many things fall into the net. You just need to make sure that there's always a commercial reason for the decisions that you make. And remember, the primary reason can't be to reduce taxes. The standard, however, was legislated to prevent people from circumventing the law through loopholes. It's kind of like a catch-all for a national treasury, basically. And then I want to point out that tax is not the only objective of an ideal structure. I've actually come across 4 other very important points I know the aim for this webinar is only to talk about the tax aspect, but it's a good idea to get exposed to the other ones. The first one being an increase in financial capabilities. This is basically the ability for the entity to obtain leverage and purchase more property. This differs between entities. Next is you want to protect your assets, your personal assets, and keep them safe from creditors. An ideal structure would be to control them and benefit from your assets without actually having to own them. And next is a reduction in your costs in maintaining these entities through life and through death. And then lastly, which I think is probably the most important if you're getting into property investing, is wealth and continuity. Depending on what your goals are and what type of assets you want to invest in and how long you want to invest in these things, you want to keep the appropriate structures there. So let's look at the different property vehicles that we have. So the ones that I want to like to talk to you about is investing in your personal name and a partnership. I've grouped these two together as the tax treatment between the two don't necessarily differ, other than your income and expenses are split in accordance with a predefined ratio in terms of a property agreement. Then we'll talk about a private company, a trust, and lastly, collective investment schemes and a real estate investment trust. I know the last two aren't necessarily within the scope of this webinar, but I thought it might be an interesting thing to touch on. So we all know that investing in your own name is a possibility. A partnership is not considered a separate legal entity, and therefore all income and expenses earned and accrued by the partnership are deemed to be earned and accrued by the members that's involved. Now, an individual is taxed based on a sliding scale from 18% to 45%. Therefore, the more you earn, the higher the tax bracket that you'll be in. Then there's also capital gains tax inclusion rate of 40%, and that's how you'll see the 7.2% and the 18%. It's basically 40% of the above two numbers. So this means that if you dispose of an asset that attracts capital gains tax, you will need to include that gain or loss at the rate of 40% in your tax return. As the income is generated in your own name, you may use the cash for whatever you want, and I'll elaborate on this further in the next slide. But just be careful when you need to separate your personal life from your business. And then you also notice that the individual has the high potential tax rate and therefore may be the poorest method of accumulating wealth. And then we have a private company. This, as we know, is a separate legal entity and is taxed in its own right. A company has a fixed tax rate of 28% with a capital gains inclusion rate of 80%. This contrasts substantially with the inclusion rate of individual of 40%. The tax, however, doesn't stop there. Shareholders are taxed further when dividends are declared at a rate of 20%. Now remember, this is a tax on the shareholder, not the company. STC was gone away in 2015, which was a tax on the company. And then we have a trust. Now, a trust is also not a separate legal entity, but they are taxed in their own right at the rate of 45%. Tax has the highest tax rate of all the vehicles and therefore remains to be the most inefficient. One important factor to remember about a trust is that they are only taxed if the income remains in the trust at the end of the year of assessment. So that means that the idea is that any income that accrues to a trust generally is distributed to the beneficiaries before the end of the year of assessment. In this way, a trust is never exposed to income tax. What's also important is that trusts are very useful for estate planning because they don't die.
Sorry, Thierry, could you just say that again? So,
sure.
If the income doesn't come out of the trust, it's not subject to income tax.
So if the income does not come out of the trust, the trust will be taxed at the rate of 45%. However,
but if it's taken out of the trust, it'll be taxed at whatever your personal tax rate is.
Correct, that's correct. Yeah. So the idea is that you want to distribute all income before the end of the year.
Oh, interesting. Okay, cool.
Yeah. So yeah, trusts are very important for estate planning as they never die. This together with the fact that they allow investors to control the asset without actually owning them is probably the only reason why people still use trusts. Therefore, if anything happens in your personal life, any assets that are housed in your trust is generally protected. And then lastly, just for the sake of completeness, we have collective investment schemes and REITs. These allow investors who basically don't have enough cash or affordability, or just don't want to be directly invested in property, but still want the exposure to the property market. They would invest in these kind of instruments. And so you can think of CISs, or as they call it, and REITs as stocks that you can invest in the JSE and things like that. Now, if you invest in a collective investment scheme, you will only be taxed when the scheme makes distributions, and they'll do this by a dividend payout. So you'll be exposed to dividends tax there, and then when you actually sell off your units to the market, you'll be exposed to CGT. Now, CISs are taxed similarly to trusts in that any income that remains in the trust is taxed. So generally, there are investment mandates which govern CISs to distribute all income before the year ends. And then lastly, we have REITs. REITs, on the other hand, are tax neutral. Tax neutral means that they are not taxed unless certain criteria are met. However, we won't go into further detail. It's just that they are similarly treated to CISs, except that the ultimate investors will be exposed to an income tax instead of a dividends tax. So next, we'll move on to the next slide, which are your applicable taxes. So this slide basically deals with the different taxes which you may come across in your property journey. The most substantial and obviously the most known is your income tax. CGT and donations tax are actually elements of income tax, as they all form part of the Income Tax Act. But in layman's terms, your income tax is your tax on your income. It's basically all your rental income less your allowable deductions that multiply by the appropriate tax rate, depending on what vehicle you use, as I've mentioned before. Next, we have capital gains tax. Capital gains tax is triggered by the disposal of a capital asset. I'll explain more on this in the next slide, that an asset can either be a capital asset or an income asset, depending on the intention of the investor when they bought this asset. So it can be either a capital asset, so your property can either be a capital asset or a income asset. So capital gains tax is typically lower than income tax purely because only a portion of the gain or loss is included in your taxable income. Donations tax is triggered when there is a gratuitous disposal. And what this means is that you are giving up something without anything in return. And I don't think many people are aware of this because there are so many exemptions in donations tax that allows you to escape out of it, but it can still be easily triggered. So for example, if you put a large amount of money into a trust or a company without getting anything in return, it's considered a donation. And now this amount will be taxed at the rate of 20%. It's easy to get out of this by making this a loan to the company or trust and charging a market-related interest. So again, anything that's less than market-related can also be considered a donation. So it's quite easy to fall into it, and it's also quite easy to escape it. So that's why I suggest that you please speak to a professional before you do your structures, and because there can be so many different implications. Next we have is estate duty, which I'm sure you're aware is, as they call it, death tax. So if you have a wealth of assets in your personal name, it can become very expensive. Estate duty is charged at the rate of 20% of the dutiable estate. And the problem with estate duty is that the amount becomes payable immediately. And generally, there's not enough cash in the estate to cover this tax. And the estate then has to liquidate its assets to pay for this tax. And this leads to further tax implications because, as I've mentioned before, CGT is triggered on the disposal of an asset. So if you're disposing of assets to pay for other taxes, you may just have a knock-on effect of further tax implications.
Thierry, just quickly on that, because a very common strategy that investors take is to work with deceased estates. So
Yes.
you've got a wealthy man or woman that passes away. They've got a few properties, and now the onus falls on the kids to sell off these properties, and they have to pay estate duties. And this becomes a very big motivation for them, and a reason why we want to come in. And so, just explain to me. Let's say that I pass away, and my kids now inherit R1 million property from me. How much would they have to pay as a estate duty to get rid of that property?
To get rid of the property or to keep it.
No, no, no. Yeah, they want to sell it off. So my kids want to sell it off because they just want to be out of the property game.
Okay, so there is a method of calculating your estate duty. As I said before, it's 20% of the estate. So depending on how much,
So 20% of R1 million as a rough figure, obviously, yeah.
depending if you have a bond on the property as well, because that'll be taken off as a deduction against your estate.
Correct. Yeah, so we'll say net asset of R1 million.
Correct.
They would have to pay 200,000 rand to SARS before they can sell the property.
Correct. Yeah. So that definitely creates a distress seller because they're working with a time variable. They would want to sell that asset in time to make sure that the estate is paid, and therefore there's a chance that they will accept a lower discount. I mean, a higher discount on the property than it's actually worth.
Yeah, that's huge. Cool. Thanks.
Yeah. Cool. So estate duty is generally not an issue for those who do not have wealth, and that's because of a substantial exclusion of around 3.5 million rand that gets taken into account. So in Laurens's example, if you have the million rand and if that's the only asset that the person had, you will have a 3.5 million rebate, or not rebate, more of a deduction. And
so only assets over and above 3.5 million
correct.
would be charged. Okay. So it has to be quite a substantial estate.
Yes. Yeah.
Got you.
Cool. So this is the next slide, which I think a lot of people are not aware of. And it basically shows you what income you should be included in your income statement, in your tax return, and what expenses are actually allowed as a deduction. So firstly, we need to note that South Africa has a residency-based taxing system. So what this means is that you're taxed in accordance of what residency you are. So if you are a tax resident in South Africa, you are taxed on your worldwide income. It doesn't matter if you receive income from another country, it needs to be included in your South African return. That being said, you probably will get certain reliefs depending on double tax agreements, but that's a chat for another day. So bear with me here. This is an extract from the Income Tax Act, and basically it defines what gross income is. And it's defined as in relation to any year or period of assessment, means in the case of any resident, the total amount in cash or otherwise received by or accrued to in favor of such resident during such year or period of assessment, excluding receipts or accruals of nature. Now, that's quite a mouthful. And there is a plethora of court cases which go into detail defining on what each one of these words actually mean. For instance, if you look at received by or accrued, there's probably over 200 cases just by going to definition by what does received by or accrued mean. But the entire gross income definition basically means that any money or something that is owed to you must be included in gross income. So this means that if you have signed a lease agreement with a tenant for a year, the tenant doesn't pay for 1 month, irrespective if you've received that money in cash, you still accrue for that in your income tax return. It doesn't matter if it's not paid. However, SARS does provide you with a relief as a deduction, which I will show in the next slide.
Wait. That's crazy. So I have a lease agreement with tenant A, and we agree that he's going to pay me 12,000 rand over the year.
Yep.
But he's a bad payer. He only pays me 9,000 rand. I still get taxed on the 12,000 that was in the lease agreement.
Correct.
Not the 9 that I received.
Yes. So let me break it down for you. If you read in a definition, it says that we include all income in cash or otherwise received by or accrued. Now that word accrued has been debated in so many different cases. And what it basically means is that you include all income that you are entitled to. Now the lease makes you entitled to that rental income, irrespective if you've received it or not. So what the Act provides you with is bad debts, right? Which is a deduction that taxpayers are allowed to claim. And this basically means that if you have stopped looking after, or stopped going after the cash from your tenant and you've written it off from your books, then you can claim that deduction and you'll be then in a net nil position. Basically, you will have your taxable line item as 9,000 in Laurens' example. Does that make sense?
Yeah. So although you're entitled to 12, you're only getting 9. There is a deduction of that 3,000 you can put into your statement. So SARS does make a provision for it. Okay, that's interesting.
Yes. However, if you are still chasing a tenant for that 3,000 rand, you don't get that deduction.
Okay.
Yeah. So next we'll chat about your general deductions. Oh wait, there's one thing I want to discuss as well, is that the only way to escape, well, not escape really, from the gross income definition is that it must be of a capital nature. And this is not as straightforward as you think. Again, there are so many court cases debating what's capital nature and what's revenue nature. SARS is always on the view that it must be income in nature because it has 100% of the inclusion rate, whereas capital gains would have 40% or 80% depending on what vehicle that you're using. So to differentiate between the two, I always like to use the analogy of a fruit and a tree example. I'm sure all accountants that's on the property call would know. There's a famous case in which this was dealt. So basically, if you bought a tree for the purpose of growing fruit and selling the fruit is considered your income, and that will be included in your income tax return at 100%. If, however, you decided to sell the tree would attract capital gains tax. Now, let's change things up. If you happened to be in the business of buying and selling trees, the trees is no longer a capital asset. This is because you entered into a scheme of profit making. Now, this generally requires a pattern of trading. So basically what I'm trying to say is just because you flipped only one property, it does not make it capital. I think this is probably one of the biggest misconceptions that I've seen so far. I've seen people giving advice saying that your first flip will be treated as a capital asset because there's no pattern. But because your intention is that you bought into this asset with the purpose of selling it and making it a profit, it means that it's an income asset. There's no fruit in this example. You're not buying it to collect rental income. But however, that being said, it's very difficult for SARS to pick it up as there's no pattern. But knowingly including this amount as a capital asset would be illegal. And I would advise that you speak to a professional before you treat something as a capital asset or an income, as it can be quite messy. And it even can get even more messy when you have a change in intention. So you can buy an asset with the purpose of collecting rental, have a change in intention, and then still be treated as an income asset. This is, however, it's quite rare. You don't see it quite often. But I just thought I'd point it out for this webinar.
Okay. Sorry, Thierry. Sorry to jump in here.
No.
I'm just doing a quick time check.
Yeah.
We've got another sort of 10 minutes until we do questions. Is that okay for you?
Yeah.
Okay.
The next 2 slides, I'll quickly go through it. It shouldn't take too long. But basically, the deductions I've mentioned before is that there's a preamble. So you basically, there needs to be a trade being conducted. It's a quite wide definition for anyone to fall into. And then with regards to deductions in terms of expenditure and losses, the main idea is that anything that you spend on must be spent on for the purposes of earning an income. And that's where most of the cases are being dealt with, is by attacking the taxpayer, saying that it hasn't been done to produce an income. Okay, so the next slide, we'll talk about practical examples. And this is probably where we all came to for this webinar. I would have done this one by one, but I think to have a holistic view, it's easy to look at. So let us assume in each scenario the taxpayer is either an individual company or a trust earning a rental income of 250,000 Rand in the year. And to earn that income, you had to make expenses of repairs and maintenance, water and electricity, your levies, management fees. And let us assume, as I said in that example before, that the tenant doesn't pay you rent to the amount of 20,000 in each case. So basically what this shows is that at lower levels of income, the individual partnership is your most efficient structure. And this is because that you are in that lowest tax bracket of 18%. If we move on to the company, it follows with the 28% and the trust with the 45%. And we don't have to go through the CISs or the REIT.
Sorry, Thierry. I think this is a brilliant slide that just shows that trusts, although in the market and people mostly think trust is the best way to go, from a tax point of view, it's the most inefficient and most costly. It's good from a protection point of view, but it's actually the least effective.
Yeah. So just to go back on what I said before, is that the trust will have the rental income of 250,000 Rand. It'll have all its expenses. And then what will happen is just before the end of the year, the trustees will come into an agreement and distribute that 100,000 Rand just before year end. The trust will then have a deduction of 100,000 Rand, then have, at the end of the year, it'll have a tax liability of 0. However, that 100,000 Rand will then be distributed to the beneficiaries, and they will have to include that 100,000 Rand in their taxable income to be taxed at their respective tax rates.
Cool.
Okay. Yeah. So now let's flip things. If we've now increased the rental income to 2.5 million Rand in each case, increase the value of the expenses at a similar ratio, you can see that at the bottom, you'll see the taxable income in all the cases is the same. However, the tax payable changes substantially. You'll see the tax payable for a individual is around 570,000, where a company is around 460,000. So now the important thing to note is that once the money's in your individual hands, you can do whatever you want with it. If you still want to take the money out of the company, you're going to be taxed further again. However, that being said, if the individual or the company is earning a lot more money, this difference just becomes even more substantial because the company is working with a fixed rate, whereas the individual's on a sliding scale. So the next slide is I want to show you is the different ways of actually pulling money out of the company. There are many different ways and some ways which I don't really advise. But the two main ways in which you can pull money out of a company is either paying yourself a salary or declaring dividends. I'll just get the trust there for completeness purposes so we can show a comparative number. So in this case, we are making the assumption that the individual is already in the highest tax bracket. And in each case, the entity is making 100,000 taxable income. So if the company pays you a salary, the company receives a deduction of 100,000 Rand. And that's why you'll see tax paid in the company of 0. Whereas when the employee receives the income, you will include that amount in its taxable income or tax return, and will pay at a rate of 45%. And will have an amount of 55,000 left over to use as however he wants to. Then if we look at a company and let's say that they have 100,000 again of taxable income, taxed at a rate of 28%, leaving 72,000 Rand left in as equity. Then the company decides to distribute the 72,000 Rand to the shareholders, and this will attract a dividends tax rate of 20% on the 72,000, not the 100,000. So you'll be left with an amount of 57,600 Rand, where the shareholders can spend on whatever they want and never again be taxed unless they go invested in something else, and so forth. The next slide will be quick. It's just about vetting a tax consultant. This list is in no way exhaustive. I'm only aware of these bodies. So you get your SAICA, which is your chartered accountants, and there are methods of verifying these members on their website. So if anyone says that they are a chartered accountant, you can go to the website and punch in their details and find out more. Then you also get your CIPA, which is your professional accountants, registered tax practitioners, which you can also vet, and chartered tax advisors. These are the only ones that I've come across in my journey as a property investor. So if anyone is not one of these, it does not mean that they can't advise you accordingly. And if they are, it doesn't mean that whatever they say shouldn't be taken lightly. And then lastly, I want to go over some misconceptions which I see people following. The first one, as I've mentioned before, is your first flip will be capital in nature. Generally, SARS won't pick this up. But if your intention is to make a flip, you've entered into a scheme of profit making, and therefore it will be taxed as income. The next is, I think majority of people will actually know this, is your bond payment is not tax deductible. And this goes to one of the first slides that I've shown, is that any expense or losses that you're claiming, it must not be capital in nature.
Sorry, Thierry. My understanding is that the interest portion of your bond repayment is deductible.
That's well pointed out, Laurens. Any interest that is paid on the bond is deductible. So
guys, just quickly on that, because this one took me a while to get. You've got income, which is rent. You've got expenses, which is things like your rates and taxes, your levies, your maintenance costs, etc. You take your income minus your expenses, you're left with profit, and that's what you're taxed on. Now, your bond repayment that you pay back to the bank, there's two parts to that payment. You've got your capital payment, so you're paying off a portion of the capital amount, and then you've got that interest portion. The interest you can take off of your income to reduce your profit and thus reduce the amount of tax you pay, but that capital amount you can't take off your income. So it's a subtle difference, but it's very important to note that.
That's a good point. Thanks, Laurens. Next point is, I only record what I've received in cash in my tax return. And as I've mentioned before, you need to include everything that you are entitled to receive and not what you actually have received. So therefore, you can be placed in situations where cash flow is an issue if you haven't received anything, but you still need to accrue for it. Next one is, a company is the most efficient tax vehicle. As I've mentioned before, at lower levels of income, it's not. Your individual capacity is perfectly capable of minimizing your tax liability. And as soon as you've passed a certain threshold, a company would become the most tax efficient vehicle. And then lastly, my goal is to pay no tax. I don't understand why people actually say this. I actually know a lot of chartered accountants which believe that there is a goal to pay no tax and accumulate losses to offset their income in the future. But you're in the business to make money. You should be wanting to pay SARS tax and trying not to avoid it or anything like that. That being said, that's the end of my slides. Thank you to all who have listened. I really appreciate the time that you've taken to share with me. And yeah, hopefully you've learned something. Thanks, Laurens.
Awesome, man. Sure. So that was a mouthful, guys. We have recorded this, so we will be sharing it. I think maybe one or two more reviews of this content will definitely help you understand this concept a little bit better. There is an online property investment course that we've released. If you just click that little green button that's on your screen, it will take you to our online university. You can go check out some of our courses if you'd like to join our program. So we're at the end of the webinar. Let's answer some questions. The first one is from Johan. It says, please explain the Section 13 tax. And I know that's probably not a one-liner, but if you could explain to us how that works in principle.
Sure. That's generally not applicable for your run-of-the-mill investors. It's generally there for your developers and those kind of things. That being said, Section 13 of the Income Tax Act is all the property deductions that are available to any of those that invest in property. So you'll get Section 13(1), which is your manufacturing allowance. That being said, that if you have a property that uses to house manufacturing, you can claim a portion of that purchase price in your tax return. Your section 6 is your residential or commercial. However, there are a lot of restrictions which come with that, such that your asset needs to be new and unused. And there are so many cases, again, which define what new and unused means. It doesn't necessarily mean that it's newly developed. It just needs to be new to you. I think legislation provides for either a 5 or 10%. I need to check. But yeah, you're allowed a 5 or 10% deduction in your tax return on that purchase price.
Yeah, there's criteria. You need to have five, is it 3 or 5 properties that
Yeah,
are new in nature, and that's when you get the tax deduction.
yeah. I think it's your low income housing, so it needs to be 5, either costing below 250,000. Something along those lines. I'll need to double check the act.
Yeah, yeah. So sorry, Johan, that's quite a tricky question, and I kind of put Thierry on the spot. So, Thierry, could me and you research that, and then
Yeah.
we can do a quick video on that, put it on my YouTube channel, so that because that's a common question, and to be honest, I wouldn't know how to answer it properly.
Yeah, I'm happy to do that.
Okay,
There are a lot of deductions I think that people don't know that they actually can claim, so it will be useful to have that there.
awesome. Okay, here's a question from Tulani. Does the trust work on calendar year or financial year or tax year?
A trust is very similar to that of an individual. They work with a year end of 28th February, very similar to an individual, whereas a company can decide of the year ends.
100%. Okay, cool. Let's see here from Vaughan. What is the best option when it comes to investment payouts? Paid into personal account or company account?
Okay, so you need to take a step back, think about what your intention is. Why do you want your investment payouts to be in a company account, or why if in your individual capacity? Remember, if the idea behind it is to lower your taxes, I would obviously advise against it. That being said, there are a lot of exemptions that are applicable to individuals on certain payouts, such as your interest income exemptions. You have dividend income exemptions. So depending on what the nature of the investment is, there are applicable exemptions for individual. That's not necessarily applicable for a company. So I would definitely consult someone to get more of an understanding on what you're trying to accomplish, and then take it from there.
Awesome. Okay, let's see here. Sure, that's quite a long question. So Brian's asking here, you spoke about purchasing your first property with some friends. So he wants to know, how did you go about purchasing the property as a group? Did you get a bond as a group, or did you all individually contribute to it?
So in the beginning, I was quite spontaneous. And that's when as I said before, I've paid my school fees, and if I could do it again, I definitely would do it differently. But the vehicle that we chose was, if I can remember, was drawing up a partnership agreement. The reason why we did this is because we were under the understanding that when you apply for a bond, it's much easier to get 100% funding if you apply for it in your own name than if you did it in a company. So we've decided to go about that route so that we can enter into the game quite quickly. Yeah, and then
Is that also a tax efficient approach? So to go individually as partners into a partnership agreement, or to register a company and do the property purchase through the company?
if you look at our specific scenario, the rental income on our first property didn't cover that of the expenses. So whether we did it in a company or whether we did it in our own names, we were never ever going to be paying tax because the expenses would outperform that of the income. If the asset was performing, considering that we just started the property game and we just came out of articles, we weren't earning that much. So we were in a lower bracket than that of a company. So that being said, it would have been more efficient to have that structure in our personal name. and benefiting with a lower tax rate than that of a company. However, partnerships can be very tricky. If one partner leaves, it has a whole host of different tax implications. Or whether another partner enters into it is also another host of tax implications. So you need to think about what you want, what your goals are, how long you're holding the property for, and that will determine what type of structure which is more ideal for you.
Yeah, it seems like it's critical to have a good partner, CA partner on board to help you navigate this, let's call it tricky environment. There are actually a couple of questions here around private consulting. So Asanda has asked for private consulting, and Kurt's also asked to get in contact with you directly. So Thierry, would you be comfortable to share your details with us on the call today?
Yes, of course. And now I gave my details to Kopolo. So I'm more than happy for him to post my email address and those things so people can get in contact with me.
Yeah, and if I understand it correctly, your partner is also a CA, and she's also doing some consulting work
Correct.
as a CA.
That's correct.
Cool.
She does only on the review and preparation of annual financial statements, management consulting, and those kind of things. But she also has a good understanding of the tax environment. And
Awesome.
together, we are more than happy to.
Yeah. Well, you guys can put your details
Yeah.
here in the chat box if you want. There, I see Chopolo's put your specific email address. So, guys, for those of you who do want to have some one-on-one time with Thierry, please also respect his time. I'm sure he's happy to have a quick conversation with you, but if it starts to become a consultation, there is a fee that is required, like with any professional that you speak to, which I think is only fair. Let's see here. Sure. Is the property that is bought in a trust name taxable through the trust?
Yes, in a certain way. So, as I said before, a trust is not a legal entity. So that means that if anyone is liable, they will sue the trustees or the beneficiaries in that case. However, the trust does pay tax in its own right. So they will file its own tax return. The beneficiaries will file their own tax return. That makes sense.
Yeah. Interesting. Okay, Johan, if I have a company, when will I be able to claim back my tax on the improvements that I've made?
I'm not sure what you mean by claiming back the taxes on the improvements.
I'm also
Generally,
not
if you
sure.
work with a capital asset, you only include the tax effect of the improvements in the year that the asset is sold. So that'll have an immediate tax effect and reduce your taxes right there. SARS is never going to pay back those taxes. However, if you're considering the fact that you pay provisional taxes, so let me give you an example. If your financial year ends 31 December, you'll have provisional tax payment dates of the middle, 6 months within, so the end of June, and then again December, and then you have a top up at the end of the year. Now, if you're expecting that you are going to sell an asset within that period, you make a provisional tax payment based on that. Then the following year is when you do your actual tax filing. And that's when people have a more accurate idea of what the numbers are. So depending on how much you've paid at the beginning with regards to provisional tax payments, if you've paid more than what you actually are meant to pay in the following year, that's when SARS will provide you with a payback. If you've paid less, obviously the works the other way, that you need to pay SARS more money.
Awesome, makes sense. Um, One of the questions here is based on everything you've discussed with us and in your own personal opinion, what would be the best structure for a multi-let strategy?
So I haven't done much of the other strategies yet, but I do think that a company is always going to be the easiest to accommodate so many different things. The ideal structure for any type of arrangements, depending on those 5 elements that I mentioned before, is that you have a trust sitting on the top, and then has your your holding company or your private company in the middle, and that company will invest in different properties. I think that covers almost every type of scenario that you can think of. And the fact that it's a multi-let strategy, I don't think it's going to change your tax efficient structure.
Cool. Yeah. So company is the way to go, most
Yeah.
likely. Cool. This might be out of the scope of today's conversation, but let's give it a go. So Paul is planning to transfer some offshore funds into his South African bank account. Is there a tax efficient way to do this?
So if it's a transferring of funds, it's not generally a tax effect, because what you are transferring is capital, and you're not going to include that amount in your gross income. Remember, it's an exclusion from your gross income. So if you're moving money between bank accounts, you're not going to be taxed on those things. However, there are other certain legislations which may have an impact on you moving money in and out of the country, and there are certain limitations on that.
Got you. I think, Paul, if you wouldn't mind, just go and check out his website, maybe send Thierry an email, because I think that's quite a detailed question to talk. Okay, 2 more questions. Actually, sorry, we already answered this one. So the last one from Banele. Okay. Let's see, there's quite a long question. So my question is that all my properties which I lease out are in my personal capacity. So he doesn't have anything in a trust or in a company. His concern is how would SARS, or how should he account for it? So my question is on how should I account for it, as I don't want to find out later that I owe the revenue.
I think I understand what he's trying to say.
Yeah, I think he's earning money in his personal capacity, but he's not declaring it to SARS. I think that's the question.
Yeah. So what you first want to do, I think, is you need to make a due diligence of your portfolio. Since it's in your own name, you do have to pay tax in your own name. I would draw up basically a spreadsheet of how many rentals you have included in your past, and etc., and then determine what type of liability you may have or may not have to SARS. And I think the next question he has here is considered transferring the properties into a trust or company, but the costs are very high. That's correct. What you would advise to avoid this? I think you need to consider what your goals are. So if you want to hold on to this property forever, it's going to accumulate wealth, and at the end of the day, when unfortunately, when you die, you're going to have to pay taxes on that. So sometimes it might be better to bite the head of the snake off now, pay those fees, move it into the appropriate structure, or pay the ultimate price of paying those SA duty fees when you die. Secondly, if you don't planning on having this investment forever, you might as well just sell it in a few years' time and pay the capital gains tax. It might even be much cheaper than that of the cost to move it over into a separate structure. So yeah, I would consult a consultant or advisor.
No. I would consult Thierry. Come on, bro, you got to sell yourself. No, fair enough. But I think that's a...
Consider to consult you outside of the webinar and help you in more detail.
Yeah, Benele, I think that's a good question. I do think it requires a little bit more. I think it requires a little bit more of a detailed conversation with you and Thierry. Tulani's asking about the criteria for choosing the right area. So Tulani, just go check out my YouTube channel. I've structured all my videos into different sections, and one section is area research. So there's a whole bunch of videos there on how to choose the best area, how to use TPN and Lightstone to validate an area, so all of that. Lastly, there was a poll, and I'm very disappointed in this poll. The poll was, who is more good looking, Laurens or Thierry? And I'm very sad to say that you won, Thierry. You got 75% of the votes. I got 25% of the votes. I don't think it's fair. But listen, man, I just wanted to say thank you. Thank you for Tulani. I'm also an Arsenal man. Come on, bro. How can I? Anyway, I want to say thanks, dude. Thank you for putting together the slides, for sharing your knowledge with us unreservedly. I I do hope that people on the call see the value of what you can provide, and go check out your website and contact you and the missus to be able to get some one-on-one time with you. But thanks so much for your time, dude. We really appreciate it.
Thanks, Laurens. I really appreciate the time to present to your audience, gives myself a nice exposure, and as well as educating the general public as to what to look out for. So thank you. Thanks again.
Awesome. Thanks everybody for joining. As always, we'll have the recording on our various YouTube channels, so register for my channel and the My Property app channel, and we will be sharing this content with you soon. Otherwise, take care and happy investing. Cheers, everyone. Bye.
Bye, everyone. Thanks.